Banking 11 System in India, Chapter 11.1. Introduction. A bank is a financial institution which is licensed by the regulator, like Reserve Bank of India, to accept deposits and extend loans. As financial intermediaries, banks act as important drivers of economic development. Banks encourage people to save. Through the coordinating function between savings and investments, banks help the process of capital formation and credit growth. It also introduces people to various financial products like insurance and helps in financial inclusion. Financial inclusion refers to making financial products and services accessible and affordable to all individuals and businesses, regardless of their position in socioeconomic strata. 11.2. Functions of banks. Banks, being the financial institutions, perform different types of functions that can be classified into two main categories. 1.2.1. Primary functions. 1. Accepting deposits. The commercial deposit banks are mainly dependent on public deposits. There are two types of deposit/accounts, i.e., demand deposit and time deposit. Demand refers to those deposits from which an amount can be withdrawn anytime by writing a withdrawal slip or a check at the bank counter or from ATM centers using debit cards. For example, savings account, current account. Demand deposit accounts pay little or no interest. Households, banks, NBFC, interest deposit, interest business firms, financial intermediaries. Figure 11.1. Functioning of financial intermediaries. As a trade-off for the funds being so readily available, time deposit refers to those deposits that are made for a certain committed period of time. For example, fixed deposits. The money deposited under this account cannot be normally withdrawn before the expiry of the agreed period. The rate of interest offered under time deposits is higher than what is offered under demand deposits. 2. Advancing loans. A bank lends a certain percentage of cash lying in deposits to the borrowers as loans. It extends loan at a higher interest rate than what it pays to its depositors for keeping their money with the banks. The difference between the interest rate charged from the borrowers and that paid to the depositors is called bank spread, cash credit call. Loans, overdraft, etc. are some ways in which a bank extends a loan. 3. Credit creation. The creation of credit is one of the most important primary functions of the banks. The banks perform this function by advancing loans and purchasing securities. A bank actually does not provide cash directly for a loan. Rather, it opens a deposit account from where the borrower can withdraw and pay the money later. This account will be used to create another credit in future. In simple terms, while creating a loan, a bank automatically creates the deposits first, which in turn will help in creating credit. 1.2.2. Secondary functions. The secondary functions of a bank can be divided into banking agency functions and general utility functions. Brief history of Indian banking. Year banks 1770. First Bank of India as Bank of Hindustan under British rule. 1806 Bank of Bengal. All three were called presidential banks. 1840 Bank of Bombay. 1843 Bank of Madras. 1921. The three presidency banks were merged into a new agency called the Imperial Bank of India in 1921. 1934. The Reserve Bank of India Act was enacted. Reserve Bank of India was set up in 1935. During the period of Great Depression, 1928 to 1934, a large number of small banks failed due to their loans going bad. To check the bank failures and to cater to the requirements of agriculture, the Reserve Bank of India Act 1934 was enacted and the Reserve Bank of India was set up in 1935. 1955. The State Bank of India was formed in 1955 with nationalization of Imperial Bank of India. 1. Banking agency functions. Commercial banks act as agents of customers by performing various functions such as collecting and clearing checks and dividends, acting as trustee, attorney, correspondent, and executor. Making the payments of various obligations of customers, such as telephone bills, accepting tax proceeds and tax returns, etc. 2. General utility functions. Commercial banks provide some utility services such as providing a money transfer facility, accepting payments for various bills, e.g., phone bills, gas bills, water bills. Providing merchant banking facilities for investing in stock market, providing locker facilities, etc. In the initial days, most banks used to serve rich families and industrial houses. And this narrowed the growth of the banking system, thin deposit rates as there were very few customers. The poor and marginalized were not been adequately served by the banks, as the banks were driven by the sole motive of maximizing profits. So, to promote rapid growth in various sectors like agriculture, small industries, and to develop all backward areas, the banks were nationalized during the prime ministerial tenure of Mrs. Indira Gandhi. Under the Banking Nationalization Act, 1969, 14 banks were nationalized and another 6 banks were nationalized in 1980. From 1993 to 94 onwards, we can see a policy reversal, where public sector banks are being liberalized and role of private banks started increasing, so as to build more efficient and bigger banks for supporting the growing India. The process of liberalization, privatization, and globalization, which began in 1991, led to increasing participation of the private sector in Indian banking. To this end, the HDFC Bank was among the first financial institutions in India to receive an in-principle approval from the Reserve Bank of India, RBI, to set up a bank in the private sector. Banking structure in India: commercial banks, cooperative banks 1, public sector banks 2, private banks 3, foreign banks, universal commercial banks, rural/urban. 4. Differentiated banks, RRB, small finance bank, payment bank. Difference between scheduled banks and non-scheduled banks. Scheduled banks, non-scheduled banks definition. They are included in the second schedule of the RBI Act, 1934. Not included under the schedule of the RBI Act, 1934. Requirements: minimum paid-up capital and other norms to be followed as per RBI guidelines, need not comply with RBI guidelines. CRR to be maintained with RBI. CRR required but can maintain with themselves returns. All returns of the banks have to be submitted as specified by RBI. Not applicable. Membership of the clearing house automatically becomes a member. Cannot become a member. Borrowing from RBI can borrow, cannot borrow. Examples: SBI, HDFC, ICICI, etc. Manipur State Cooperative Bank Limited, Coastal Local Area Bank Limited, and various other local banks or small-scale banks. Scheduled banks, commercial banks, public sector banks, SBI and associate banks, other nationalized banks, other public sector bank, private sector banks, foreign sector banks, regional rural banks, co. Operative banks, unscheduled banks, RBI. Figure 11.2. Types of banks 11.3. Various types of banks in India 1.3.1. Differentiated banks and universal banks. RBI grants 2 kinds of banking licenses: universal bank license and differentiated bank license. Differentiated banks, niche banks, are created to serve the needs of particular segments of the population. Small finance banks and payment banks are the examples of differentiated banks in India. Custodian banks and wholesale and long-term finance, WLTF, banks are newly proposed differentiated banks as they are set to provide to the niche sector of long-term finance. Universal banks are large banks that operate an extensive network of branches and provide many different services. ICICI is an example of a universal bank. 1.3.2. Commercial banks. Commercial banks are organized under the Banking Companies Act, 1956. Their main objective is profit. Commercial banks comprise the following: 1.3.2.1. Public sector banks. Public sector banks or PSBs are those banks where the direct holding of the central/state government or other PSBs is 51% or more. 1.1.3.2.2 Private banks. The Nursing Home Committee on Financial Sector Reforms in 1991 recommended the creation of private banks for bringing in more efficiency in the sector. Based on these recommendations, licenses were issued to 10 private banks. In 2001, RBI again issued new rules for the licensing of new banks in the private sector based on the Nursing Home Committee I report, which had envisioned 4 tiers in the banking structure of India. Tier 1. International banks, 3 to 4 banks. Tier 2. National level, 8 to 10 banks. Tier 3. Regional level. Tier 4. Rural banks, 1 2 to 3. Foreign banks. As per the Organization for Economic Cooperation and Development, OECD, a foreign bank is a bank with head office outside the country in which it is located. Foreign banks in India can either directly operate through branch presence, or they can set up a wholly owned subsidiary with near national treatment. 1.1.3.2.4 Small finance banks, SFBs. They are niche banks to further financial inclusion based on the recommendation of the External Advisory Committee of the Reserve Bank of India. It is primarily concerned with basic banking activities of acceptance of deposits and lending to unserved sections. It can sell forex to customers, sell mutual funds, insurance, and pensions. Also, SFBs are allowed to provide remittances as well as issue credit and debit cards. It can also convert into a full-fledged bank. However, there are difference between universal scheduled commercial banks and payment banks parameters. Universal scheduled commercial banks payment banks CRR, SLR maintenance have to maintain. Need to maintain CRR required to invest a minimum 75% of its demand deposit balances in statutory liquidity ratio, SLR, eligible government securities / treasury bills with maturity up to 1 year. Deposit no limit 2 locks loan can give loan cannot give loan. Few functions that SFBs are restricted to perform. They cannot extend large loans, cannot float subsidiaries and deal in sophisticated financial products. They have to maintain CRR and SLR as per RBI's norms. They have to extend 75% of its credit towards priority sector lending obligations. At least 50% of its loans should be up to Rs. 25 locks only. 1.1.3.2.5 Payment banks. These banks were set up with an objective to further financial inclusion by providing small savings accounts and payment services to the underserved. India Post Payment Bank, IPPB, populations by minimizing the costs. They were recommended by the Nachikeet More Committee on Financial Inclusion. They will not lend to customers and will have to deploy their funds in government papers and bank deposits only. People can only deposit an amount of up to Rs.100,000 now raised to 200,000 rupees and cannot apply for loans or credit cards under their account. However, payment banks are allowed to issue debit cards. Further, payment banks are allowed to distribute products such as mutual funds, insurance, and third-party loans and can provide remittance services. Difference between payment banks and small finance banks features. Payment banks, small finance banks, minimum paid-up capital requirements, 100 crores, 200 crores, max account balance, 2 lakhs. No such limit. Deposits can accept lending task, no lending allowed. No credit cards issued. Do both deposit as well as lending functions of the banks. Can issue credit cards. Deployments of funds. 75% of total deposits should be invested only in government, securities, and rest of deposits in other banks or in cash. 75% lending via PSL. 50% loan portfolio should be 25 lakhs each. IPPB is a wholly owned subsidiary of the Department of Post with 100% Government of India equity. It is governed by the Reserve Bank of India, RBI. It offers services through both physical and digital platforms. The maximum limit on deposits is 2 rupees lakh. It can issue debit cards and ATM cards, but cannot issue credit cards and cannot loan money. It provides social security payments like MREGA wages, direct benefit transfer, and gives access to third-party services, insurance, mutual funds. The account holders of IPPB are issued a QR code-based biometric card with a unique QR code. 1.1.3.2.6 Regional Rural Banks, RRB. 1976. They are special types of banking institutions which focus on ensuring adequate credit for agriculture and other rural sectors. They were set up on the basis of the recommendations of the Nursing Home Working Group, 1975, which led to Regional Rural Banks Act. They are a joint venture between the central government, 50%, state government, 15%, and a commercial bank, 35%. There is a requirement that 75% of their total credit should be given under priority sector lending. Prathama Grameen Bank in Moradabad was the first RRB set up in 1975. 1.1.3.2.7 Local Area Banks, Labs. Government wanted to set up new private local banks with jurisdiction over 2 or 3 contiguous districts to enable the mobilization of the rural savings by local institutions and make them available for investments in local areas. They were introduced in 1996. They are established as commercial banks in the private sector and registered under the Companies Act 2013. They are regulated by the RBI and PSLs. Priority sector lendings are applicable to them like commercial banks. They cannot establish branches in more than 3 districts and majority of the branches should be in rural areas. 1.3.3 Cooperative banks. It was initially set up to supplant indigenous sources of rural credit, particularly money lenders. Today they mostly serve the needs of agriculture and allied activities, rural-based industries, and to a lesser extent, trade and industry in urban centers. 1.1.3.3.1 Recent changes with the regulatory framework of cooperative banks. There have been several instances of fraud and financial irregularities, including the recent issues like failure of Punjab and Maharashtra Cooperative, PMC, in 2019. All these issues have flagged the poor monitoring in these cooperative banks. Therefore, few changes were made under the Banking Regulation Amendment Act, 2020. 1. The RBI may supersede the board of directors of a multi-state cooperative bank for up to 5 years under certain conditions, protection of depositors, public interest, etc. 2. The Act allows the central bank to initiate a scheme for reconstruction of a bank without placing it under a moratorium. 3. The changes in the new Act will not in any way affect the existing powers of the state registrars of cooperative societies under state laws. 4. The cooperative banks will be allowed to issue equity, preference, or special shares at face value or at premium. However, prior approval from the RBI is mandatory for such issuance. 5. The Act allows cooperative banks to open new places of business or change the location of the banks without the permission from RBI. 6. The Act mentions that RBI may exempt a cooperative bank or a class of cooperative banks from certain provisions of the Act. Difference between scheduled commercial banks and scheduled cooperative banks. Scheduled commercial banks, scheduled cooperative banks registered under Companies Act, 1956. Cooperative Societies Act of 1912 regulated by RBI dual regulation. 1. RBI for banking functions. 2. Registrar for Cooperative Societies, RCS, for administrative functions regulated under Banking Regulation Act of 1949. Banking Regulation Act of 1949 along with banking laws. Application to Cooperative Societies, Act, 1965. Level of operation at a single level. Operates at 3 levels. 1. State level. 2. District level. 3. Village level. Voting rights depends on shareholding of the member, 1 vote objective. To provide financial services and to earn profits out of it works on the principle of cooperation and maximization of benefits for all members primarily. Revised Regulatory Framework, Categorization of Urban Cooperative Banks, UCBs, for regulatory purposes. RBI has revised the UCB's regulatory framework based on the recommendations of Expert Committee on Urban Cooperative Banks and S. Vishwanathan panel. For strengthening the financial soundness of the UCBs have been categorized into following 4 tiers for regulatory purposes. Tier 1. All unit UCBs and salary earners UCBs, irrespective of deposit size, and all other UCBs having deposits up to 100 Indian rupees crore. Tier 2. UCBs with deposits more than 100 Indian rupees crore and up to 1,000 Indian rupees crore. Tier 3. UCBs with deposits more than 1,000 Indian rupees crore and up to 10,000 Indian rupees crore. Tier 4. UCBs with deposits more than 10,000 Indian rupees crore. 11.4. NBFC, NON Banking, NBFC, is a company registered under the Companies Act, 1956. NBFCs engage financial company in the business of loans and advances, financial company acquisition of shares/stocks/bonds/A. Securities issued by government or local authorities. NBFCs do not include any institution whose principal business is that of agricultural activity, industrial activity, purchase or sale of any goods other than securities, or providing any services and sale/purchase/construction of immovable property. Currently, there are close to 10,000 NBFCs spread across the country. The entire NBFC sector is about 25% of the assets of the banking industry. Based on their liability, NBFCs have been classified into 2 broad categories, viz. Deposit-taking NBFCs, NBFCD, need to register with RBI, and non-deposit-taking NBFCs, NBFCND. Based on their primary function, they are also classified as Asset Finance Company, AFC, Investment Company, IC, and Loan Company, LC. Difference between banks and NBFC parameters. Banks, NBFC Registration, Banking Regulation Act, Companies Act, Supervision, RBI. Depends on the category. 1. RBI, deposit-taking NBFC. 2. SEBI, Venture Capital Fund, Merchant Bank, Stockbroking Firms. 3. IRDA, Insurance Company. 4. National Housing Bank, Housing Finance Company. 5. Min of Corporate Affairs under Companies Act, 1956, Nitty Company. 6. Chit Funds Act, 1982, Chit Fund Company. Deposit time and demand deposit only, time deposit issuing checkbook. Can issue checks as per Payment and Settlement Act, 2007. Cannot issue reserve ratio. They have to maintain as per RBI guidelines. Do not have to maintain, but those who are taking time deposits have to maintain 15% SLR. Loan rate, MCLR. Variable depositor money cannot deposit depositors' money in the share market. Can deposit depositors' money in the share market. Unlike banks, priority sector lending have to maintain, not required. Credit as the growing importance of the NBFC in relation to credit extended by SCBs. Sector in the Indian financial system is also. NBFCs could absorb the shocks of reflected in the consistent rise of NBFCs the pandemic, as they were supported by proportion to GDP as well as various policy initiatives. FY13, FY15, FY17, FY19, FY21, H1, FY. The continuous improvement in asset quality is seen in the declining GNPA ratio of NBFCs from the peak of 7.2% recorded during the second wave of the pandemic, June 2021, to 4% in March 2024. Figure 11.4. Sectoral GNPA ratio of NBFCs. NBFCs maintained robust credit growth in 2023 to 24 despite some moderation in the second half of the year. Personal loan growth decelerated, whereas growth in loans to industry and services accelerated, as can be seen in Figure 11.5. Growth in industrial advances was largely contributed by the government NBFCs. Figure 11.5. Sectoral credit growth of NBFCs. Y1.4.1. Recent development in NBFC sector. NBFCs are facing many problems nowadays, viz. liquidity crunch due to slowdown in fundings because of conflict between RBI and government on the matter of providing easier fund flows to NBFCs. This was aggravated by a series of defaults like that of infrastructure leasing and financial services, IL and FS. In January 2021, RBI proposed a 4-tier structure for tighter regulation of NBFCs. It has also proposed the classification of non-performing assets, NPAs, of base layer NBFCs from 180 days to 90 days overdue. Earlier in 2020, RBI announced various measures to provide liquidity support to NBFCs, 4-tier structure for tighter regulation of NBFCs. According to RBI, the regulatory and supervisory framework of NBFCs should be based on a 4-layered structure: base layer, middle layer, upper layer, and a top layer. 1. NBFC base layer. Lower layer, it requires least regulatory intervention. It can consist of NBFCs which are currently classified as non-systemically important NBFCs. 2. NBFC, middle layer. It will consist of systemically important NBFCs, NBFC and DSI, deposit-taking NBFCs, NBFCD, housing finance companies, IFCs, IDFs, SPDs, and core investment companies. It will have a stricter regulation regime as compared to the base layer. 3. Upper layer. This layer will consist of NBFCs which have large potential of systemic spillover of risks and have the ability to impact financial stability. The regulatory framework for NBFCs falling in this layer will be bank-like, albeit with suitable and appropriate modifications. 4. Top layer. Ideally, this layer will be empty. If certain NBFCs lying in the upper layer are seen to pose extreme risks as per supervisory judgment, they can be put to higher regulatory/supervisory requirements. 1.4.2. Ombudsman Scheme for NBFCs. The RBI launched Ombudsman Scheme for non-banking financial companies, NBFC, for redressal of complaints against them, which will provide a cost-free and expeditious complaint redressal mechanism relating to deficiency in the services by NBFCs covered under the scheme. 11.5. Reserve Bank of India. RBI was established on April 1, 1935, in accordance with the provisions of RBI Act 1934, on the recommendation of the Hilton Young Commission. It was established as a private shareholders bank with a share capital of 5 crore, and it was nationalized on January 1, 1949. RBI functions as the Central Bank of India. Initially headquartered in Calcutta, it was later shifted to Mumbai in 1937. It has 4 zonal offices: Delhi, Mumbai, Calcutta, and Chennai. A central bank basically differs from commercial banks in a number of ways. Like a central bank does not work with a motive of making profit, while commercial banks aim to earn profits. It acts in public interest so as to regulate the banking and financial system of the country. A central bank does not perform ordinary commercial functions such as accepting deposits from the general public in the country. A central bank has the sole authority to issue currency, while commercial banks cannot. Every country has only one central bank, while there can be a number of commercial banks functioning in a country. 1.5.1. Functions of RBI. 1. RBI is the sole authority to issue currency notes of various denominations except 1 rupee notes, which are issued by Ministry of Finance. 2. RBI is considered as the banker to the government. It maintains the account of the central government and all the states. It lends to the government as well as manages the government's borrowing program. All financial transactions of governments are undertaken through RBI. Shri Krishna Committee has suggested transfer of public debt management function from RBI to a new agency called Public Debt Management Agency. 3. It is considered as a banker's bank. Banks have to maintain accounts and reserves with the RBI. It advises banks on financial matters. It provides an interbank clearance facility for settlement of their mutual claim. It lends to the banks in the good as well as bad times. That's why RBI is known as a lender of the last resort. It aids eligible commercial banks during temporary liquidity problems. 4. It regulates banks as well as NBFC partially. It issues licenses to new banks. 5. It acts as the supervisors of payment system. In that capacity, it sets norms for transfer of funds domestically as well as internationally. Instruments of transfer of funds are checks, draft, postal orders, NEFT, RTGS, IMPS are under its purview. 6. It is the custodian of foreign reserves of the country. 7. It regulates convertibility norms as per Foreign Exchange Management Act, FEMA, 1999. It also helps in stabilizing the exchange rate of rupees. 8. It is concerned with publication of monetary data, like monetary policy report, financial stability reports. 9. RBI plays an important role in promoting economic development of the country. For example, promoting financial inclusion, ensuring compliance of PSL's targets, etc. 10. IT regulates money supply in the economy through the instrument of monetary policy, thus playing a significant role in keeping inflation within a healthy range. Various sections of RBI and New Section Y News Explanation Section 35 in 2019, RBI placed several this section best power in the RBI to give banking restrictions on them by based directions to banks and can take action. To regulation Punjab and Maharashtra prevent the affairs of any banking company act, 1949. Cooperative, PMC. Bank couldn't issue loans or open any fixed deposit accounts until February 2020. RBI imposed the said restriction under Section 35A of the Banking Regulation Act, 1949. 2. Being conducted in a manner detrimental to the interests of the depositors or in a manner prejudicial to the interests of the banking company. Section 56 of the Act is applicable to cooperative societies. Section 7 of the central government has it empowers the central government to the RBI Act use Section 7 of the Reserve. Give directions to the RBI to serve the 1934 Bank of India Act, 1934 for the first time in 2018. Larger public interest after consultation with the governor of RBI. These directions can lead to transfer of powers from RBI to the Central Board of Directors. The board will exercise all powers and do all acts and things which may be exercised or done by the bank. The board comprises of a governor, deputy governors to be appointed by the center, not more than 4. 4 directors to be nominated by the center, and 1 government official nominated by the center. Section 47 in 2019, Union Finance as per this section, profits or surplus of the RBI. Minister Nirmala Sitharaman of the RBI are to be transferred to the Act. Informed Lok Sabha that transfer of surplus reserves from the RBI to the government in future would depend on net income and other financial parameters of the RBI besides the recommendations of the Expert Committee on Excess Capital. Government, after making various contingency provisions, public policy mandate of the RBI, including financial stability considerations. 4711.6. Economic Capital Framework. The RBI has developed an Economic Capital Framework, ECF, to provide an objective, rule-based, transparent methodology for determining an appropriate level of risk provisions, capital kept aside to cover risks, under section of the RBI Act, 1934. It was developed in 2014-15 and was operationalized in 2015-16. It reflects the capital that an institution requires or needs to hold as a counter against unforeseen risks or losses in the future. RBI keeps 27% of its assets as reserve while other central banks, like in the US, keep only 14%. Thus, the government believes that RBI is sitting on much higher reserves than it actually needs to tide over financial emergencies that India may face. In 2018, the Reserve Bank of India, RBI, in consultation with the central government, had constituted a committee under Dr. Bimal Jalan to review the Economic Capital Framework. The committee recommended 1. RBI to maintain the contingency risk buffer, CRB, which is the country's fund to handle financial stability within the range of 5.5% to 6.5% of the RBI's balance sheet. The total economic capital should be maintained between 20.8% to 25.4% of the RBI's balance sheet. Previously, it was 28.1% to 29%. Thus, the surplus distribution policy of RBI was finalized. Further, following these recommendations, RBI decided to transfer 1.76 rupees lakh crore in dividend and surplus reserves to the government in August 2019. 2. It also said the RBI's accounting year of July-June can be brought in sync with the fiscal year of April-March from the financial year 2020 to 21. 3. The report has also removed the interim payout structure in general circumstances. The payment of an interim dividend may then be restricted to extraordinary circumstances. 4. The committee recommended a review of the ECF after 5 years. All the recommendations of the panel have been accepted by the RBI. 11.7. Priority sectors lending, PSL. Priority sectors mean those sectors which are considered important for the development of the basic needs of the country and are to be given priority over other sectors. Through PSL's provisions, banks are encouraged to provide these sectors with adequate and timely credit. This is done to ensure their holistic and comprehensive growth. In July 1966, the All India Rural Credit Review Committee recommended that the commercial banks should play a complementary role in extending the rural credit. However, the definition for PSL was only formalized based on Reserve Bank of India, RBI, report in the National Credit Council in 1972. These sectors include agriculture, micro, small and medium enterprises, MSME, export credit, education, housing, social infrastructure, renewable energy, recently added, startups, recently added, etc., among others. In September 2020, RBI released revised PSL guidelines by expanding the scope of priority sector lending to include startups funding up to 50 rupees crore and loans to farmers for installation of solar plants and compressed biogas plants. It has defined farmers with land holding of up to 1 hectare as marginal farmers and farmers with a land holding of more than 1 hectare and up to 2 hectares as small farmers. To ensure continuous flow of credit to the priority sector, the compliance of the bank is monitored on a quarterly basis. If banks fall behind their stipulated priority sector lending targets, then they have to allocate the balance amount to the Rural Infrastructure Development Fund, established with NABARD and other such funds with NABARD, NHB, SIDBI, etc., as decided by the RBI from time to time. Priority sectors lending requirement category. Domestic commercial banks and foreign banks with 20 branches and above foreign banks with less than 20 branches, regional rural banks, small finance banks total 40% of 40% of 75% of 75% of priority adjusted net bank adjusted net sector credit, ANBC, or credit equivalent of off-balance or bank credit equivalent of bank credit of credit or equivalent off-balance or bank credit equivalent sheet exposure OFF, BAL and CE sheet exposure BOF, CEOBE. Sheet exposure whichever is balance sheet whichever is higher should go EXPOSURE higher should go to higher, out of the priority sector whichever is priority sector. which up to 32% can be in the form of lending to exports, and not less than 8% can be to any other priority sector higher, should go to priority sector agriculture. 18% of adjusted net bank credit or credit equivalent of off balance not applicable. 18% of adjusted net bank credit or credit equivalent of off balance 18 bank or percent of adjusted net credit equivalent. Sheet exposure, whichever is higher, out of which a target of *10% is prescribed for small and marginal farmers, SMFs. Asterisk will be implemented in a phased manner. Sheet exposure, whichever is higher, out of which a target of *10% is prescribed for small and MARGINAL farmers, SMFs. Asterisk will be implemented in a phased manner. Balance EXPOS, whichever higher, out of a target *10 is for small MARGIFARM, SMFs. Off. Sheet URE is which of percent prescribed, and NALERS asterisk will be implemented in a phased manner. Micro 7.5% of not applicable. 7.5% of 7.5% of enterprises adjusted net bank credit or credit equivalent of off is higher. Adjusted net bank credit or credit equivalent is adjusted bank credit higher net credit or balance sheet of off balance E2IVALENTXPOSURE sheet exposure of off, whichever is higher EXP balance sheet OSURE whichever is higher advances. 12% of not applicable. 15% 12% asterisk to weaker ANBC or CO of ANBC sections whichever is higher. Asterisk will be implemented in a phased manner. Or CO, whichever is higher asterisk will be implemented in a phased manner or CO, whichever is higher asterisk will be implemented in a phased manner. 1.7.1 Priority Sector Lending Certificates, PSLCs. PSLCs are a mechanism to enable banks to achieve the priority sector lending target and subtargets by purchase of these instruments in the event of shortfall. This also incentivizes surplus banks as it allows them to sell their excess achievement over the prescribed targets, thereby enhancing lending to the categories under priority sectors. 11.8 Financial Inclusion, FI. It is a method of offering banking and financial services to individuals. It is giving financial services to all regardless of their income or savings, thus including everyone in society. As per the Committee on Financial Inclusion, it may be defined as the process of ensuring access to financial services and timely adequate credit where needed by vulnerable groups such as weaker sections and low-income groups at an affordable cost. 1.8.1 Objectives of Financial Inclusion. It provides banking for the unbanked groups. It ensures universal access to bank accounts, basic no-frills banking accounts, for making and receiving payments. Further, it ensures access to credit at a reasonable cost for those presently excluded. It secures the unsecured by providing universal coverage of insurance and Social Security. Figure 11.6 Progress under PMJDY. 1.8.2 Financial Inclusion in India. Around 510 million accounts, more than 55% beneficiaries are women, have been opened under the Pradhan Mantri Jan Dhan Yojana, PMJDY. These zero-balance bank accounts have been accompanied by more than 300 million debit cards, a life insurance cover of 30,000 rupees, and a free accidental insurance cover on rupee cards which has been increased from 1 rupee lakh to 2 rupees lakhs for PMJDY accounts opened after August 28, 2018. The RBI observed that there has been a 24% improvement in financial inclusion, FI, as measured by RBI's FI index between March 2017 and March 2021. However, millions of Indians still remain outside the financial safety net. The government is making concerted efforts to widen the financial inclusion blanket. Steps taken by Indian government. Initiatives purpose PM Mudra Yojana providing loans up to 10 lakhs to the launched in 2015. Enterprises. These loans are given by commercial banks, RRBs, small finance banks, MFIs, and NBFCs. The loan limit has been increased to 20 lakh under Tarun category in budget 2024 to 25. Mudra has created 3 products, namely Shirshu, Kishore, and Tarun, to signify the stage of growth/development and funding needs of the beneficiary micro-unit/entrepreneur. PM JAM, JNDHA and ADHA Mobile, Yojana Trinity, was first proposed in the Economic Survey 2014 to 15. The government intended to use these 3 modes of financial inclusion to implement direct subsidy transfers to the poor. Indian Post Payment Bank launched in September 2018. Aimed at making banking service available at doorsteps. National strategy has following state pillars for financial universal access to financial services inclusion. Access to livelihood and skill development launched by RBI for the Customer Protection and Grievance Redressal period 2019 to 2024. Effective coordination among all the stakeholders providing basic bouquet of financial services. National strategy has been launched for a second time by the RBI for the financial period of 2020 to 2025. Education. The strategy launched for the second time has recommended 2013 to 18, 2020 to 25, a 5C approach: content, capacity, communication, community, collaboration for dissemination of financial education in the country. It includes emphasis on the development of relevant content in the curriculum in schools, colleges, and training establishments. Further, it aims to develop capacity among intermediaries involved in providing financial services, leveraging the positive effect of community-led model for financial literacy. It has to be achieved through an appropriate communication strategy and enhancing collaboration among various stakeholders. NSFE also aims to advance the skills of financial service providers and other intermediaries involved in imparting financial literacy. Stand Up India to leverage the institutional credit structure to reach out scheme to the underserved sector of people such as SCs, STs, and launched by the Prime Women Entrepreneurs. The Stand Up India scheme makes minister in 2016. Provision for a collateral-free loan, 1 to SC/STs and 1 to a woman entrepreneur, between 10 lakhs to 1 crore per bank branch. The loan is to be extended for development of a greenfield project. Atal Pension Yojana, APY, launched in 2015. Its objective is creating a universal social security system for all Indians, especially the poor, the underprivileged, and the workers in the unorganized sector. APY is open for all bank account holders in the age group of 18 to 40 years. The contribution differs based on pension and amount chosen. Credit to promote entrepreneurship among SC by providing enhancement credit guarantee to banks and other financial institutions that guarantee provide scheme, CEGS, for financial assistance to these entrepreneurships. Scheduled castes. Was announced by Government of India in the Union Budget of 2014 to 15. Pradhan Mantri was established to provide life insurance security to the poor Jivan Jyoti Bima and low-income section of the society. It is available to people Yojana in the age bracket of 18 to 50 years. Risk coverage under this launched in 2015. Scheme is for rupees 2 lakh in case of death of the beneficiary due to any reason. The premium under the scheme is rupees 330 per annum. Pradhan Mantri. It intends to provide an affordable insurance scheme for the Suraksha Bima poor and underprivileged people in the age group of 18 to Yojana, PMSBY. 70 years with a bank account. The risk coverage under the launched in 2015. Scheme is rupees 2 lakh for accidental death and full disability and rupees 1 lakh for partial disability. The premium for the scheme is 12 rupees per annum. Sukanya. It is a small deposit scheme for girl child. It provided in Samriddhi Yojana interest rate of 8.4% and tax benefits to every account open launched as a part of the under it for July-September 2019. The Sukanya Samriddhi Beti Bachao account can be opened at any post office or branch of campaign in 2015. Authorized commercial banks in the country. The permissible contribution under the scheme ranges from rupees 250 to rupees 1.5 lakh in a financial year. 11.9. Measuring the financial position of a bank. 1.9.1. Bank run. It is a situation where a large number of customers withdraw their holdings from a bank simultaneously based on low credibility of the bank, causing the collapse of the bank. This situation arises when there are concerns about the bank's solvency. This may arise when a bank has mismanaged its assets and liabilities or failed to have sufficient liquidity for the short to medium term. For example, if a bank XYZ has invested all its deposits in a huge long-term loan, and if a situation arises that this loan turns into NPA, the bank may not be in a position to honor its daily withdrawals. It might lead to a situation where the bank will be unable to pay its liabilities, prompting other customers to seek to withdraw their deposits in a short period, causing collapse of the bank. Silicon Valley Bank is the largest bank to fail in the USA after the 2008 financial crisis due to consistent increases in interest rates by Federal Reserve, which ultimately led to a bank run situation. 1.9.1. Avoiding bank run. CRR. In order to avoid a situation of bank run, the bank should maintain adequate liquidity to manage day-to-day liability settlements. Also, there is a requirement to maintain adequate capital, CAR/to handle risks of loans turning into NPA. Further, all deposits in India are statutorily protected for up to an amount of 5 lakh rupees under Deposit Insurance and Credit Guarantee Corporation Act, DIC. In case of mismatch of assets and liabilities, the government/regulator should step in a timely manner to avoid bank run. For example, during the recent bank run threat of Yes Bank, RBI stepped in and put daily withdrawal limits upon depositors and also tried to recapitalize the bank. Moreover, the regulator should warn such high-risk banks. For example, in India, RBI brings such banks under prompt corrective action framework. Deposit Insurance and Credit Guarantee Corporation, DICGC, was established under the DICGC Act 1961 as a wholly owned subsidiary of the Reserve Bank of India, RBI, for the purpose of providing insurance of deposits and guaranteeing of credit facilities. After the latest amendment, DICGC insures all bank deposits, such as serving, fixed, current, recurring deposits, etc., for up to a limit of 5 lakhs rupees. The insurance premium is paid by the insured banks themselves. This means that the benefit of deposit insurance protection is made available to the depositors or customers of banks free of cost. DIC protects depositors' money kept in all commercial and foreign banks located in India, urban cooperative banks, regional rural banks, local banks, etc. 1.1.9.2. 2008 global financial crisis. In the post-2000s, there was a huge appreciation in the cost of real estate bubble in the United States of America. Banks started lending in excess policy, hoping the bubble may bring good returns. But over a period of time, the rate of increase in the prices of real estate was reversed. In this sector ceased, and there were many unsold real estate properties, which in turn led to huge NPAs and bank crisis. As the bubble burst due to severe fall in demand, the prices of the sector came crashing down, and the banks had nothing else other than mortgages, which were also becoming less valued. This news about the crisis in the U.S. banks started to spread, which led to huge withdrawals. This forced a bank run on many banks, like Lehman Brothers. As many of these banks closed their operations, U.S. went into a period of recession, and the whole world was affected by it. U.S. Federal Bank pumped money into the economy. Expansionary monetary bought many mortgages and gave liberal credit to other banks. U.S. government also made many tax cuts and started huge public expenditure programs, expansionary fiscal policy, to tackle such a situation. The international experiences of the failure of banks like that of Lehman Brothers in 2008, which led to global crisis, led to various stakeholders adopting various standards to avoid such incidents. 1.9.2. Capital Adequacy Ratio. Capital adequacy ratio is defined as the percentage of total capital to the total risk-weighted asset. It is also called capital to risk-weighted assets ratio, CRAR. It is fixed by the central banks, RBI in India, to prevent commercial banks from taking excess borrowed money, leverage from deposits and other sources. 9%, and thus avoiding insolvency. As per RBI norms, Indian scheduled commercial banks are required to maintain a CAR of, while Indian public sector banks are emphasized to maintain a CAR of 12%, a higher requirement compared to that stipulated by Basel III at 8%. Tier 1 capital plus Tier 2 capital CAR equals risk-weighted assets, note Tier 1 capital. It is the primary funding source of the banks, and it is known as the core capital. It consists of share capital, undistributed profits, and some preference shares which a bank can use to absorb losses without ceasing business operations. Tier 2 capital is the supplementary capital. It includes revaluation reserves, hybrid capital instruments, and subordinated term debt, general loan loss revenues, and undisclosed reserves. It is less reliable than Tier 1, and most of the time if Tier 2 is used to avoid bank failure, it may end up by ceasing the business operations. Tier 3 capital unsecured, subordinated debt makes up Tier 3 capital and is of lower quality than Tier 1 and Tier 2 capital. 11.10. Basel norms. Basel norms are the set of agreed norms in an effort to coordinate banking regulations across the globe by the Basel Committee of Banking Supervision, BCBS. It focuses on reducing the risks to banks and the financial system. In general, banks lend to different types of borrowers, and each lending carries its own set of risks. This lending comes from the deposits of the public as well as money raised from the market, i.e., equity and debt. This exposes the bank to a variety of risks of default, and as a result, they might get into a situation of financial crisis, 2008 subprime crisis. To avoid bank run/financial crisis, banks should set aside a certain percentage of capital as security against the risk of non-recovery. Basel Committee on Banking Supervision. It acts as a forum for regular cooperation on banking supervisory matters for the central banks of different countries. It was set up by the efforts of central bank governors of the group of 10 countries in 1974. The committee expanded its membership in 2009 and then again in 2014. Now, the Basel Committee on Banking Supervision has 45 members from 28 jurisdictions, consisting of central banks and authorities with responsibility for banking regulation. This committee works under the auspices of Bank of International Settlement, BS, in Basel, Switzerland. Bank for International Settlements, BS, is an international financial institution that aims to promote global monetary and financial stability through the coordination of global central banks and their monetary policy efforts. It is often called the central bank for central banks. Till date, the Basel Committee has issued 3 sets of regulations which are known as Basel I, II, and III. 1.10.1 Basel I. It was introduced in 1988, and it focused almost entirely on credit risk. Credit risk is the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligations. To overcome an unexpected credit risk, the minimum capital requirement was fixed at 8% of risk-weighted assets, RWA. For example, an asset which is backed by collateral would carry lesser risks, hence may require lesser provisioning, as compared to loans without collateral, higher risk. Similarly, an asset lent to the government may have lesser risk than the asset lent to private individuals. India adopted Basel I guidelines in 1999, 11.10.2, Basel II. These guidelines were issued in 2004 and were based on three parameters, three pillars. 1. Capital adequacy requirements, which require the banks to maintain a minimum capital adequacy ratio of 8% of risk-weighted assets. 2. Supervisory review, which requires the banks to develop better risk management techniques in all the three types of risks that a bank can face: credit risk, market risk, and operational risks. 3. Market discipline, which requires greater transparency in the banks. Banks should mandatorily disclose their CAR, risk exposure, and other such risk assessment parameters to the central bank periodically. India has been working as per Basel II norms and is in the transition period to Basel III norms. 1.10.3, Basel III. Basel III guidelines were released on the backdrop of 2008 financial crisis. It was issued in 2010 as many financial institutions were undercapitalized, over-leveraged, and had a greater reliance on short-term funding. It was based on three main parameters. 1. Capital. The capital adequacy ratio, CAR, should be at least 8%. In this, common equity tier 1, CET, must be at least 4.5% of risk-weighted assets, RWA. The tier 1 capital must be at least 6% and total capital must be at least 8%. Apart from this capital, banks should also maintain a capital conservation buffer of 2.5% and a countercyclical buffer of 0 to 2.5%. 2. Leverage. The leverage ratio has to be maintained at a maximum of 3%. The leverage ratio is the ratio of a bank's tier 1 capital to its total assets. In simple terms, leverage ratio can be defined as the capacity to meet its financial obligations. It is the proportion of debts compared to its capital. 3. Enhanced risk and disclosure. These include the revised disclosure requirements for credit risk, operational risk, leverage ratio, credit valuation adjustment, CVA, risk-weighted assets, RWA, and key prudential metrics. 11.10.3.1. Funding and liquidity. As per Basel III, there are two liquidity ratios, viz. LCR and NSFR. 1. The liquidity coverage ratio, LCR, is the ratio of high-quality liquid assets to the debt of the bank. These high-quality liquid assets provide liquidity for at least 30 days of stress in case of uncertainty. It helps to prevent bank run-like situations. 2. The net stable funds rate, NSFR, is the rate at which banks can raise funding from their off-balance sheet assets and other activities in medium term, up to 1 year. Hence, NSFR is a measure for medium term, 1 year, resilience. Basel III norms were to be implemented from March 2019 in India. It was postponed to March 2020 due to economic slowdown. Further, in the light of the coronavirus pandemic, the RBI decided to further defer the implementation to April 2021. As per new draft master direction on prudential regulations, AIFI are supposed to comply with Basel III guidelines from April 2022, and the NHBs have to comply with the same from July 2022. Basel III Pillar I Enhanced Minimum Capital and Liquidity Requirements, Pillar 2 Enhanced Supervisory Review Process for Firm Wide Risk Management and Capital Planning, Pillar 3 Enhanced Risk Disclosure, and Market Discipline, Figure 11.7, Basel III Norms 11.11. SWIFT Society for Worldwide Interbank Financial Telecommunication, SWIFT. Founded in 1973, is a messaging network that facilitates safe and secure financial transactions through a standardized system of codes. Under the laws of its country of origin, Belgium, it is registered as a cooperative and is owned by its member financial institutions. As a means to ensure glitch-free global financial transactions, SWIFT assigns a unique 11-digit ID/code to each of its member institution. This code gives the financial institution a distinct ID and is used to identify the bank name, country, city, and branch. Though SWIFT is an important part of the global financial structure, it is not, and does not perform the functions of a conventional financial institution. Presently, the SWIFT network is used by more than 11,000 financial institutions in more than 200 countries. During the Ukraine crisis, 2022, 7 Russian banks were banned from using the SWIFT messaging network as a part of economic sanctions for Russia's invasion of Ukraine. In India, the Parliamentary Committee looking into the Personal Data Protection Bill 2019 has recommended that India should strive to build an indigenous alternative to SWIFT payment system. Data protection in the financial sector is an important concern as Indian citizens are engaged in huge cross-border payments using the SWIFT system. 11.12 Non-performing assets, NPS. Non-performing assets, NPAs, are loans given by a bank or a financial institution wherein the borrower defaults or delays interest or principal payments. According to the RBI norms, any interest or loan repayment delayed beyond 90 days has to be identified as a non-performing asset. Initially, banks notify a loan as NPA if it is not repaid on time. In order to recover the loan, the bank may even restructure it. The bank may also write off some part of the loan. But in reality, all these assets are a cause of problems at present or a potential cause of economic mismanagement in future. The stressed asset captures all these aspects and hence it is considered as a better indicator of the banking system. 1.12.1. Other technical criteria for defining an NPA include: 1. An account remains out of order in respect of an overdraft/cash credit, OD/CC. 2. The installment of principal or interest thereon remains overdue for 2 crop seasons for short-duration crops. 3. The installment of principal or interest thereon remains overdue for 1 crop season for long-duration crops. 4. In respect of derivative transactions, if the overdue receivables remain unpaid for a period of 90 days from the specified due date for payment. 1.12.2. Categories of non-performing assets. 1. Substandard. Assets which have remained NPA for a period less than or equal to 12 months. 2. Doubtful. An asset will be classified as doubtful if it has remained in the substandard category for a period of 12 months or more. 3. Lost assets. Those assets considered uncollectible and of such little value that its continuance as a bankable asset is not warranted, although there may be some salvage or recovery value. Related concepts. Restructured loans. To reduce the NPAs and to increase the possibility of loan recovery, a bank can make certain relaxations to the borrowers. Such loans after relaxation are known as restructured loans. Restructuring can be extended in the way of extending the time period of repayment, reduction in interest rates, etc. Even though restructured loans are not classified as NPA, they come under the broad category of stressed assets, as they are not the standard asset, those assets which are regularly repaid. Written off assets. A write-off is an accounting action that reduces the value of an asset. In other words, those non-collectible assets which are not expected to play a role in the future income to the balance sheet of the banks are removed from the balance sheet by the process of write-off. It doesn't mean that the borrower is pardoned or exempted from paying a loan. A write-off is different from a write-down, where an asset's book value is partially reduced but is not totally eliminated. For example, a man X failed to pay 1 Indian rupee lakh due to the bank. Initially, the bank's balance sheet will have a column of receivables which will mention this 1 lakh with interest. Based on this receivable, the bank will plan for new loans or investments in the future worth about 1 Indian rupee lakh. But if this 1 lakh is not returned for a long period of time and there are very little hopes of getting it, the bank should not plan its asset position having this 1 lakh in receivables. Hence, it's just removed from the receivable books of the balance sheet. Stressed assets. Stressed assets are a combination of all assets which are not standard in nature. It is an indicator of the health of the banking system. Stressed assets equals NPAs plus restructured loans plus written-off assets. Gross non-performing assets. GNPA is the total value of gross non-performing assets for the bank in a particular quarter or financial year, as the case may be. Net non-performing assets. NNPA subtracts the provisions made by the bank from the GNPA. Therefore, NNPA gives us the exact value of non-performing assets after the bank has made specific provisions for it. GNPA ratio is the ratio of the total GNPA to the total advances, while NNPA ratio uses NNPA to find out the ratio to the total advances. 1.12.3 Reasons for high non-performing assets and stressed assets. Various reasons, as reported by the government documents since 2013-14, have been cited for the upsurge in the NPAs of the PSBs. By now, the major ones are being considered as given below. 1. Stressed balance sheets of corporates due to economic slowdown can have spillover effect in bank balance sheets also, twin balance sheet problem. This will lead to a vicious cycle as lower lending to corporates will diminish their productivity, which in turn will reduce their ability to honor their liabilities, aggravating the stressed assets situation of the banks. 2. Lending to unworthy customers low creditworthiness, without adequate due diligence. 3. Project completion was delayed for various reasons, judicial delays, policy paralysis, economic slowdown, infrastructure bottlenecks, etc. 4. Business failure because of overestimated optimistic projections. 5. Diversion of funds meant for expansion/modernization. Borrowed funds are not utilized for the purposes which they have borrowed. 6. Willful defaults, siphoning of funds, frauds, misappropriation, etc. 7. Lack of skill on the part of the banks to monitor end use of funds and diversion by the borrower through a web of shell companies. 8. Deficiency in credit appraisal and improper due diligence. However, since the middle of the previous decade, RBI and the government have made dedicated efforts in terms. Note: SCBs stand for Scheduled Commercial Banks, PSBs stand for Public Sector Banks, PBBs stand for Private Sector Banks, FBs stand for Foreign Banks. Figure 11.8. Select Asset Quality Indicators. Note: SCBs stand for Scheduled Commercial Banks, PSBs stand of calibrated policy measures like strengthening the regulatory and supervisory framework, implementation of 4 R's approach of recognition, resolution, recapitalization, and reforms to clean and strengthen the balance sheet of the banking system. These continuous efforts over the years have resulted in the enhancement of risk absorption capacity and a healthier banking system balance sheet both in terms of asset quantity and quality over the years. Consequently, the asset quality of SCBs has improved over the years across all major sectors. The GNPA ratio has decreased from 8.2% in March 2020 to a 7-year low of 2.8% in March 2024, while net non-performing assets, NNPA, have dropped to a 10-year low of 0.6% of total assets. Lower slippages and the reduction in outstanding GNPAs through recoveries, upgrades, and write-offs led to this decrease. Lower GNPAs, combined with high provisions accumulated in recent years, contributed to a decline in NNPA. Moreover, with shrinking GNPAs, the provisioning coverage ratio, PCR, has been increasing steadily since March 2021 and reached 76.4% in March 2024. The CRAR of SCBs has been rising sequentially in the post-asset quality review period. It remains well above the minimum capital requirement, including capital conservation buffer, CCB requirements of 11.5%, 1.12.4, tackling the NPA crisis. To resolve the NPA crisis, following steps have been taken and passed by the government. 1. 5/25 refinancing. Under the scheme, lenders were allowed to extend the tenure of loans to 25 years with interest rates adjusted every 5 years. 2. Asset quality review. It is a review or assessment of the credit risk associated with an asset, in line with RBI loan classification rules. It enables quicker classification of NPAs and timely identification of other stressed assets and thereby providing an overall picture of the Figure 11.9. Capital to risk. Weighted assets ratio well-being of the banks. 3. S4A scheme for sustainable structuring of stressed assets. This scheme envisages determination of the sustainable debt level for stressed borrower and bifurcation of the outstanding debt into sustainable debt and unsustainable debt. The bank hires an independent agency which decides on sustainable management of the company up to a limit where it can generate resources. The unsustainable debt is converted into equity and preference shares. 4. Asset reconstruction companies. ARCs are specialized financial institutions that buy non-performing assets, NPAs, from banks and other financial institutions. This helps banks to concentrate on normal banking activities, cleaning up their balance sheets. They were introduced in India under the SARFAESI Act, 2002, as specialists to resolve the burden of NPAs. Budget 2021-22 envisages asset reconstruction company to be set up by state-owned and private sector banks. Further, there will be no equity contribution from the government. This is being considered as the government's version of a bad bank, which handles the bad assets. National Asset Reconstruction Company Limited, NERCL, and India Debt Resolution Company Limited, IDRCL. Bad bank is a corporate structure announced in 2021 budget that isolates risky assets held by banks in a separate entity. Under the approved structure, bad bank will consist of 1. NERCL, to acquire and aggregate NPA/bad loan accounts, with majority stake in NERCL being with public sector banks, with Canara Bank as sponsor. 2. IDRCL, for management and value addition and will handle the debt resolution process, with majority stake in IDRCL being with private sector banks. 5. Debt Recovery Tribunal, DRT. 1993, the DRTs and Debt Recovery Appellate Tribunals were established under the Recovery of Debts and Bankruptcy Act, RDB Act, with the specific objective of providing expeditious adjudication and recovery of debts due to the creditors, banks, and financial institutions. The securitization and reconstruction of financial assets and enforcement of security interests, SARFAESI Act passed in 2002 also provides access to banks and financial institutions covered under the Act to the DRTs. 6. Mission Indradhanush for banks. It is a 7-pronged strategy to resolve issues faced by public sector banks. A. Recapitalization of public sector banks. Bank recapitalization is a term used for infusing capital in state-run banks in order to make them compliant with capital adequacy norms. The process is mainly carried through bank recapitalization bonds. The government issues bonds which are subscribed by the banks. The money collected by the government goes back to the bank in the form of equity capital. The money invested by banks in recapitalization bonds earn them an interest. As the government increases its share of equity holdings, it leads to shoring of banks' capital reserves. Recapitalization of 20,000 Indian rupees crores was proposed in the budget 2021 to 22. In December 2020, the government infused 5,500 rupees crore in Punjab and Sindh Bank. In April 2021, government also notified that it would infuse 14,500 rupees crore through recapitalization bonds in 4 public sector banks by issuing non-interest-bearing bonds to banks. B. Bank Board Bureau. BBB is a body of eminent professionals mandated to select and appoint board members for various financial institutions in the public sector. The BBB is also required to undertake governance activities. In these institutions, it will also appoint the non-executive chairman of PSBs. BBB helps to formulate appropriate strategies for growth and development of the concerned financial institutions. Financial Services Institutions Bureau, FSIB. Appointments Committee of the Cabinet, ACC, has approved a government resolution for establishing the Financial Services Institutions Bureau, FSIB, in place of the Banks Board Bureau, BBB. It is set up under the Department of Financial Services, DFS, Ministry of Finance, 2. 1. Recommend persons for appointment as whole-time directors and non-executive chairpersons on the boards of financial services institutions, including public sector banks, PSBs. Public sector insurers, PSIs, and financial institutions, FIs. 2. Advise on certain other matters relating to personnel management in these institutions. 3. Promote excellence in corporate governance in public sector financial institutions. C. Appointments. It was decided to separate the post of chairman and managing director. Also, it was decided to appoint a person as non-executive chairman of PSBs to ensure appropriate checks and balances. D. Distressing PSBs. More debt recovery tribunals, DRT, ARCs, etc., to be set up to fasten the recovery of bad loans of the banking sector, so as to make a vibrant debt market for PSBs. E. Accountability. Under this mission, a new framework of accountability for banks will be fixed based on key parameters. F. Governance reforms. A set of new reforms will be given by the government to improve the efficiency of the public sector banks when required. G. Empowerment. Under this, the banks will be empowered to take independent decisions for quicker resolution of NPAs and faster decision-making. 11.13. Bank consolidation. Merging PSU banks is envisaged to make them able to absorb shocks and generate capital without depending on the state exchequer. The motive behind the decision is to modify public sector banks to suit the credit needs of the growing economy that is India. This will also promote better efficiency and reduce duplication of works performed by many public sector banks. In August 2019, the government announced the merger of 10 public sector lenders into 4 bigger and stronger banks. With that, the number of public sector banks in India came down to 12 from 27 in 2017. The process of mergers is set to continue as and when required. For example, the recent merger of Canara Bank with Syndicate Bank, Union Bank of India merged with Andhra Bank and Corporation Bank. 11.14. The Insolvency and Bankruptcy Code, IBC. Insolvency is a situation which arises due to inability to pay off the debts due to insufficient assets. Bankruptcy is a situation where an application is made to an authority declaring insolvency. Thereafter, a formal proceeding is initiated so that the assets of the bankrupt organization can be liquidated to pay off the debts. The Parliament enacted Insolvency and Bankruptcy Code, 2016 to provide a uniform, comprehensive insolvency legislation encompassing all companies, partnerships, and individuals. It is a one-stop solution for resolving insolvencies, which previously was a long process that did not offer an economically viable arrangement. It aims to protect the interests of small investors and make the process of doing business less cumbersome. The code specifies a time frame of 180 days after the process is initiated, plus a 90-day extension for resolving insolvency, so that any insolvency or bankruptcy is solved within a maximum of 270 days. A major feature of the code is that it creates 4 pillars of institutional infrastructure for administering the bankruptcy procedure. 1. Insolvency and Bankruptcy Board of India, IBBI, to regulate and oversee the new entities. 2. Insolvency professionals to conduct the insolvency resolution process. 3. Insolvency professional agencies will examine and certify the insolvency professionals. 4. Information utilities which will collate and disseminate financial information related to debtors. 5. Adjudicating authority, National Company Law Tribunal, NCLT, and Debt Recovery Tribunal, DRT. NCLT adjudicates insolvency resolution for companies while DRT adjudicates for individuals. National Company Law Appellate Tribunal, NCLAT, is the appellate authority for hearing appeals against the orders passed by NCLT. Based on the asset's value and debtor type, IBC provides for different corporate insolvency resolution processes as 1. Corporate Insolvency Resolution Process, CRP. 2. Prepackaged Insolvency Resolution Process, PIRP, and 3. Fast-Track Corporate Insolvency Resolution Process, FIRP. When an asset becomes stressed, the balance sheet strain causes poor upgradation and investments in the company, leading to further decline in the value of assets of the company. So, at least a time-bound resolution will save some assets for the bank for those unviable companies. 11.15. Project SASH Act. It is a 5-pronged strategy to resolve bad loans, suggested by PNB Chairman Sunil Mehta and accepted by the government. The 5-pronged resolution route will enable a standard operating procedure to deal with any type of NPA. 1. SME resolution approach for dealing with bad loans up to 50 Indian rupees crore, involving creation of a steering committee by banks for formulating and validating the schemes, with a provision for additional funds. 2. Bank-led resolution approach for loans between 50 Indian rupees crore and 500 Indian rupees crores, with the resolution being achieved in 180 days. 3. Asset Management Company, AMC/Alternative Investment Fund, AIF, led resolution approach to deal with NPA cases of more than 500 Indian rupees crore. Alternative Investment Fund will raise resources from banks and institutional investors so that it can bid for the insolvent assets under insolvency and bankruptcy. 4. National Company Law Tribunal, NCLT/IBC approach for assets larger than 500 Indian rupees crore already before the NCLT and any other assets whose resolution is still pending. The Asset Trading Platform for both performing and non-performing assets. 11.16. Prompt Corrective Action, PCA, Framework. The PCA framework works as an early warning signal for banks in stress. The Reserve Bank of India has specified certain regulatory trigger points for undertaking a prompt corrective action, PCA, framework. These trigger points include capital to risk-weighted assets ratio, CRAR, net non-performing assets, NNPA, and return on assets, ROA, to Tier 1 leverage ratio. While the capital, asset quality, and profitability were the key areas for monitoring in 2017's framework, this time round capital, asset quality, and leverage are the key areas from January 1, 2022. RBI initiates certain structured and discretionary actions in respect of banks hitting such trigger points so that failing of banks is avoided. 11.17. Supervisory Action Framework, SAF, for urban cooperative banks. The SAF is similar to the Prompt Corrective Action, PCA, based on 3 parameters such as when net non-performing assets, NPAs, exceed 6% of net advances, when losses are incurred for 2 consecutive financial years or losses have accumulated on the balance sheets, and when capital adequacy ratio, CAR, falls below 9%. When such criteria are met, the urban cooperative banks are brought under RBI, and RBI can also take action if there are serious governance issues. This is especially relevant in the backdrop of a large number of cooperative banks failing like the Punjab and Maharashtra Cooperative, PMC, bank crisis, and the recently reported nearly 1,000 cases of fraud worth more than 220 Indian rupees crore in past 5 fiscal years. 11.18. Domestic Systemically Important Bank, DSIB. According to the RBI, some banks become systemically important due to their size, cross-jurisdictional activities, complexity, and lack of substitute and interconnection. Banks whose assets exceed 2% of GDP are considered part of this group, and these banks are too big to fail. This means that the economic heft of the entity is such that the government cannot afford to let it fail. The State Bank of India, SBI, ICICI, and HDFC banks are under this category. In order to ensure extra financial prudence, these banks are required to maintain additional capital requirements over and above the standard norms. 11.19. Committees on Banking. Committees on Banking. Nursing Home Committee, I. 1991. 1. A 4-tier hierarchy for the Indian banking system with 3 or 4 major public sector banks at the top and rural development banks for agricultural activities at the bottom. 2. A quasi-autonomous body under RBI for supervising banks and financial institutions. 3. Reduction in statutory liquidity ratio. 4. Reaching 8% capital adequacy ratio. 5. Deregulation of interest rates. 6. Full disclosure of banks' accounts and proper classification of assets. 7. Setting up an asset reconstruction fund. Nursing home. The task of the committee was to review the progress of the committee. 2. Implementation of reforms and to suggest a design for further 1998. Strengthening of the sector. 1. The committee recommended the merger of major public sector banks. However, the committee warned against merging stronger banks with weaker banks. 2. Committee recommended narrow banking concept where the banks, especially with high NPAs, were allowed to put their funds in short-term and risk-free assets. 3. It also recommended that government ownership of banks should be reviewed as it hampers the autonomy of banks, resulting in mismanagement. 4. The committee wanted banks to reduce their NPAs to 3% by 2002. It also recommended the formation of asset reconstruction funds or asset reconstruction companies. The recommendations led to the introduction of securitization and reconstruction of financial assets and enforcement of Security Interest Act, 2002. Nachikeet Committee, set up in 2013. Committee on Comprehensive Financial Services for Small Businesses and Low-Income Households. 1. Universal banking for all Indians above the age of 18 years. To achieve this, a vertically differentiated banking system with payments banks for deposits and payments and wholesale banks for credit outreach. 2. Aadhaar to be the prime driver towards rapid expansion in the number of bank accounts. 3. Adjusted 50% priority sector lending target with adjustments for sectors and regions based on difficulty in lending. PJ Nayak 1. Repeal the Bank Nationalization Act, 1970-1980, the SBI Act. Committee, 2014, and the SBI Subsidiaries Act. This is because these acts require the to review government to have above 50% share in the banks. Governance of. 2. The government should set up a bank investment company, BIC, boards of banks. As a holding company or a core investment company. 3. The government to transfer its share in the banks to this BIC 4. Until the BIC is formed, a temporary body called the Bank Boards Bureau, BBB, to be formed to do the functions of the BIC. Once BIC is formed, the BBB will be dissolved. 5. The BBB will advise on appointments to the board, bank's chairman, and other executive directors. 11.20. Recent initiatives of government. 1.20.1. Shadow bank. A shadow bank is a type of financial intermediary facilitating the creation of credit across the global financial system, carrying out bank-like activities, but outside the regulatory oversight. The shadow banking system may consist of lenders, brokers, and other credit intermediaries who fall outside the realm of traditional regulated banking. Hedge funds, NBFCs, etc., are examples of shadow banking in India. 1.20.2. Payment and settlement system. In India, the payment and settlement systems are regulated by the Payment and Settlement Systems Act, 2007. Accordingly, RBI is mandated to commence or operate a payment system in India. It is an important function of the central bank whereby the objectives of safety and efficiency are promoted by monitoring existing and planned systems. By overseeing payment and settlement systems, RBI helps to maintain systemic stability and public confidence in the payment and settlement system. 1.20.3. National Payments Corporation of India, NPCI. NPCI is the specialized division of RBI, created for operating retail payments and settlement systems in India. It is an initiative of RBI and Indian Banks Association under the provisions of the Payment and Settlement Systems Act, 2007, for creating a robust payment and settlement infrastructure in India. It has been incorporated as a not-for-profit company under Section 8 of Companies Act, 2013. 1.20.4. Unified Payments Interface, UPI. Unified Payments Interface is an instant real-time payment system developed by NPCI facilitating interbank transactions. The interface is regulated by the Reserve Bank of India. It can lead to instant money transfers through mobile devices, giving round-the-clock services. It can be used as a single mobile application compatible with different bank accounts. The UPI app is inbuilt with a robust grievance redressal system. 1.20.5. Ban on dealing in virtual currencies. The Reserve Bank of India prohibited entities regulated by the bank to deal in virtual currencies, VCs, or provide services for facilitating any person or entity in dealing with or settling VCs. Winter session of the Parliament, November 29, 2021 to December 23, 2021, had put the Cryptocurrency and Regulation of Official Digital Currency Bill, 2021 for introduction, consideration, and passing. It seeks to prohibit all private cryptocurrencies in India while allowing for certain exceptions that promote the technology of cryptocurrency. Also, creates a framework for digital currency that will be issued by the Reserve Bank of India. Recently, Central Board of Direct Taxes, CBDT, has amended income tax rules to specify ways to comply with the new TDS provision on virtual digital assets, VDAs. 1.20.6. Merchant discount rate. The merchant discount rate is the cost that a merchant pays to banks for accepting payment from their customers via digital means. This cost is often passed on to the customer. 1.20.7. Gold investment scheme. Sovereign gold bonds and gold monetization schemes are gold investment schemes that were launched by GOI in 2015. The scheme aims to reduce the dependence on imported coal by mobilizing the physical gold with households in a productive way through sovereign gold bonds. 1. Sovereign gold bonds. These are government securities denominated in grams of gold, issued by RBI. Investors have to pay the issue price in cash, and the bonds will be redeemed in cash on maturity. The minimum and maximum investment limits are 1 gram and 4 kilograms of gold per person per fiscal year, 20 kgs for trust and other such entities. The tenor of the bond is for a period of 8 years with an exit option from the 5th year onward. 2. Gold monetization scheme. In the scheme, BAS, Bureau of Indian Standards, certified CPTCs, collection, purity testing centers, collect the gold from the customer on behalf of the banks. The minimum quantity of gold, bullion, or jewelry which can be deposited is 10 grams, and there is no limit for maximum deposit. In short, the scheme allows you to deposit your idle gold with the Reserve Bank of India, RBI, designated bank and earn interest on the same just like a bank fixed deposit. Gold saving account can be opened with any of the designated banks with denominations in grams of gold for short-term period of 1 to 3 years, a medium-term period of 5 to 7 years, and a long-term period of 12 to 15 years. The CPTCs transfer the gold to the refiners. The banks will have a tripartite/bipartite legal agreement with refiners and CPTCs. The customers will have the option of redemption either in Indian rupee, according to the prevalent price of deposited gold, or in gold. 1.20.8 Account Aggregator Framework. Account Aggregator, AA, is a non-banking financial company, NBFC, engaged in the business of providing the service of retrieving or collecting financial information pertaining to the customer. No financial information of the customer is retrieved, shared, or transferred by AA without the explicit consent of the customer. AA transfers data from one financial institution to another based on an individual's instruction and consent. Registering with an AA is fully voluntary for consumers. Entities may enroll themselves on AA framework as financial information provider, FIPVIS. Banking company, non-banking financial company, asset management company, depository participant, insurance company, insurance repository, pension fund, etc. And as financial information user, FIU, which is an entity registered with and regulated by any financial sector regulator. In this direction, RBI has issued the Direction Biz. Non-banking financial company, account aggregator, Reserve Bank, directions, dated September 2nd, 2016. At present, RBI has granted a certificate of registration to 6 companies as AA. Achievements so far. 1. As on December 31st, 2022, 27 financial institutions have gone live as FIPs, including all 12 PSBs, 10 private sector banks, 1 small finance bank, and 4 life insurance companies. 2. 119 financial institutions have gone live as FIUs Viz, 93 RBI regulated, 12 SEBI regulated, 12 IRDI regulated entities, and 2 PFRDA regulated entities. 3. With 23 banks on board to the account aggregator framework, more than 1.1 billion bank accounts are eligible to share data on AA. 3.3 million users have linked their accounts on the AA framework, out of which 3.28 million users successfully shared data via AA. 4. RBI has also notified Goods and Services Tax Network as FIP on November 23, 2022, which will enable digital invoice financing and provide much-needed credit to the MSME sector. Assets, MiCA. European Parliament has recently, EU, 11.21. Markets in crypto. The Pass the Markets in Crypto Assets, MiCA legislation, which is expected to regulate the crypto industry. It is considered as the first set of regulations in the world establishing a legal framework for crypto asset services providers, as well as customer protection. It will apply directly across the European Union without any need for national implementation laws. MiCA regulation focuses on certain categories of crypto assets which are currently out of scope of existing regulations, i.e., it does not apply to non-fungible tokens, NFTs. DeFi, decentralized finance, and central bank digital currencies, CBDCs. MiCA is part of the European Commission's digital finance strategy, which also includes the Distributed Ledger Technology, DLT, pilot regime, and the Digital Operational Resilience Act, DORA.